Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. So today I'd like to welcome Robert Carras. Robert Carras is CIO of Bank Gutmann. Welcome to the podcast.
Hey, Sophocles. Good seeing you and hearing you. I mean, for our listeners, I think it's also interesting how we know each other, because we have actually known us for quite some time. What was your first year you came to ValueX?
Yeah. Robert and I met in clusters. I think that was, 8 years ago, I think. And actually, I do think I have a picture of you, Vitali, and Paolo right above the frozen river. And we look so much younger.
Don't mention it. When I started going to ValueX more than 10 years ago, I still had hair on my head. See, times are changing. But I also went to your event in Cyprus in 2021, and I'm looking forward to September when I will go again. So thank you for putting it all together. I mean, you're now you always have done a great job, and now you're extending your line of events, and it's for the benefit of everyone. Everyone enjoys coming to your events. They're really great.
Thank you, Robert. Well, if I didn't have amazing people like you, then I wouldn't have much of an event.
That's all. You're bringing the good people together. That's good.
All I do is just make sure there's good food and wine.
That's for sure. There's great food in Cyprus.
So, Robert, you went to Japan, which is a country I've never been to. I've been to Asia like 6 times, but I've never been to Japan. I saw you put a couple posts on LinkedIn on it. I'd love it for you to, tell us about your experience. Well, maybe first of all, sort of like, why did you go to Japan? Is like what Bank Gutmann going to Japan? Is it like for investments? Do you have like clients there? And then you can, we'll just take it from there.
Thanks, Sophocles. I have a long-term fascination with Japan. And by the way, it was a LinkedIn user when I posted about Japan who said, I want to know more. And I said, maybe I can do more. Maybe we can do a podcast about Japan. So that's how it all started. And I've been there once. I think it was in 2003 or so. I was at a firm where we picked hedge funds. So we met a number of hedge funds. We met, for example, Sparks Asset Management. They're still around today. But back then, the bubble burst end of the 80s, and everyone was super conservative. And the few hedge funds that were out there, they were also probably more outsiders in society that were able to do their own thing. But in general, nothing would ever change in Japan was the feeling back then, because companies were hoarding cash. They were shocked by all these events when the bubble burst. And so they completely overcapitalized. So they wanted to cover all the risks that could come. So if there would be an earthquake that would destroy everything, they want to have the cash to rebuild everything, and they wanted to make sure they can pay all the employees. So there was super conservative posture on Japan. And it was interesting in the year of, I think it was 2012, Monish Pabrai talked about buying nets in Japan and putting a basket together. And I thought, that sounds interesting. So I had a Bloomberg screen running, and I put together a basket myself of around 6 stocks. So and I looked at the filter I used back then, and I think it's still sensible, because I looked at companies that are profitable, that pay a dividend, that even might buy back stock, which hardly any company did anyway. And I wanted to have industries that I can understand. And the funny thing was, with these overcapitalized companies, at some point it got to a ridiculous point, and then the stock price moved, because if you have like 10 times the stock market capitalization in cash on the balance sheets, something's going to happen. But looking back at it now, and I had to open my Excel sheet because it was in 2012, I wouldn't remember anymore. And the basket did pretty well. I had one stock, it was called Hirano Tech Seed, 6245. And I bought it in June 2012, and it tripled in a year. And all in all, the basket went quite well, and some of the stocks are held for 3 years till 2015. But looking back, I only got lucky because that was about the time when Shinzo Abe, the prime minister, started the now famous Abenomics. So there was an initial wave of, hooray, things will change in Japan. And that's what lifted all these stocks. But that was like a one-time lift because nothing really changed then for another 10 years. So things take a little bit longer in Japan, it seems. But now there were some tangible signs over the last few years that now things are really gaining traction. And why were they gaining traction? Because the Tokyo Stock Exchange implemented measures. Yeah, it was early 2023, the Tokyo Stock Exchange demanded that all listed companies take action. And it was back then, it was called, so first of all, they had a council of experts concerning the follow-up of market restructuring and then action on cost of capital conscious management. So they wanted management to be more cost of capital conscious. So they wanted management to think about the returns on the capital they employ and also on the shareholder returns. And so, yes, coming back to your questions, yes, I went to Japan in June, beginning of June last year, and we have a partner in Japan called Aspoma that managed a Japan portfolio for us, and they organized the trip. And they also have a Japanese colleague in Japan that helped us there because you still need translation in Japan. Now you can say, how can that be? How can that be? You go to Japan, you meet investor relations, and they don't speak any English. Yeah, maybe they do speak English, but they feel more comfortable in Japanese. And you also have to remember that for the last 10 years, no one cared. So no one came to Japan to talk to the companies, or very few. So there was not a lot of incentive to have a really international team. And when we went to Japan in June last year, we met 22 companies. And out of the 22 companies, only one did the whole thing in English.
Which company did it all in English?
There was SMC. They're in the automation field. It's an international world leading company. So the guy there was really savvy and did the whole pitch in English and was well done. So I like that. But all the others, they felt more comfortable having also a Japanese guy that translated. And what I also noticed is that the senior person, mostly men, but also women, they felt especially more comfortable in Japanese. But there was always a second person, again, was man or woman, and that person was much more fluent in English, but was the more junior person. So I think there is a new generation coming up that will feel much more comfortable in English. But I think you have to prepare a lot in Japan anyways. At our colleagues at Aspoma, Harald Staudinger and Clemens Kustner, they were really well prepared. So we sent questions to the management before what we wanted to know. So they prepared all the answers. They won't give it to you, but it is in front of them. So it's all, I guess, cleared by the different positions.
So you couldn't ask questions while you were there. It had to be pre-submitted.
The important questions were pre-submitted, so we could immediately dive in. And sometimes they already did send something back to build on it. But you could ask questions there, and with the help of our translator, Tabata-san, and he knows his stuff. So you not only need a translator, but you need a person that understands what you want, that understands the business. And so you need a professional. Not a translator. It's our guy in Japan. He's really an investment professional with a lot of experience, and he knew what we wanted to get out of the meeting. But you also need like the cultural filter, because you will not always get the straightforward answer, but you have to also read between the lines. When I went to Japan and met all these companies, there was not a single one that ignored the measures of the Tokyo Stock Exchange. And we saw big companies, like I mentioned, the big world-leading companies, but also small companies that wouldn't be even listed in other countries with only a few $100 million of market cap. And even they talked about two things. And the two things they talked about was return on equity and price to book. So every company needs to have measures to lift the stock price above book value, because there are a lot of companies that are trading below replacement value, below book value. And so they have to say, what are our measures to bring up the stock above book value? And the other thing is, what are our measures to improve our return on equity? These are the two measures they picked out of all the different Tokyo Stock Exchange measures. So somehow everyone agreed on using these two measures to focus on.
So wait, you're saying now the stock exchange, not the regulator, can impose certain measures, and these guys fall. So I have so many questions on this. So first of all, what exactly was the measure? I mean, the measure was you have to bring up your return on equity or else we'll delist you. I mean, can you like spell it out for us so that we can understand.
So what they try to do is to change the mindset about capital efficiency. And I think it's also in interest of the entire Japanese company, because if all this capital is trapped within the balance sheets, it's not productive, it's not helping anyone. So it's good for everyone to put the capital to work. And so what the Tokyo Stock Exchange did is said, okay, we give you some good and bad case studies. We give you a list of companies that apply these measures, and tell us what you will do. And I'm just looking at their 2025 update, and there they said initially 90% of prime companies responded. And they also said, if you want to be listed in the prime segment, you have to comply with these measures. Otherwise, you risk a down rating into other segments. And so they not only wanted the disclosures, they also showed what are good examples, what should you do. And they also interviewed international investors what they want to see and tried to implement that. And they also showed how these measures improve stock prices.
I'm going to play devil's advocate here.
Sure.
And to me, listening to that, the stock exchange went and told them how to properly manage their company, because this is essentially what's going on here. It seems to me it's less likely that this happened because I think the exchange imposed it, but probably more likely that the old guys are dead and then you guys who have been to business school and have been listening to Warren Buffett and all the other, let's say, quality investors, or basically opening almost any book written over the last 20 years about capital allocation, are now in charge.
There's also certainly a factor that there's a generational shift. That's what I also anecdotally heard and saw when there was management changes and the next generation taking over, that this facilitated changes. But I think it's also that I will always be an outsider to Japan, and I don't want to sound ignorant, because Japanese people are super smart, well educated, so it's not a lack of knowledge. I think changes in Japan happen also slower, because there's a lot of respect involved, because you respect what people have built, you respect the way they do it, and so this respect is something that probably held them back also. So you have to try to do it all in a respectful way, and maybe that's also makes it even more unusual what the Tokyo Stock Exchange did, because they put it out there, and then some of the big companies moved along those lines, and suddenly everyone else felt forced to comply with that, because you always have this societal consensus in Japan, and now the consensus shifted to we have to do it that way. We have to reduce those cross holdings, for example, so all the smaller ones can follow the example of Toyota, for example, to reduce the cross holdings. And also to have independent board members. So you can measure all these statistics. So the number of independent board members have been going up, and a lot of different things. I mean, there are so many funny things in Japan. One funny thing is, for example, the AGMs. The AGMs in Japan, if I look back here to the 90s, 96% of all AGMs were held on the same day. So if you wanted to go and see the companies and ask these critical questions, you have to pick one, because they all had it on the same day, or in the same week. Maybe it was not on the same day, maybe it was in the same week. But yeah, I think even the concentration on the peak day was 96%. So, and the argument for that was that the Yakuza, so the Japanese mafia, if you can call it that way, they disrupted those meetings, and there was a lot going on in the 80s. And also 90s, and that was the defense to do it all. But it also came in quite conveniently, I think, because then you didn't have all these stupid foreigners asking all these stupid questions. But that also changed, and now only 25% are on the same day anymore. So you have all these tangible measures that things are really changing, and I think we now have the wind in our backs in Japan. And companies are really getting much more cost of capital conscious, yeah.
And it's funny because when I was, I skimmed over JVC Kenwood and Nippon Paint yesterday, and I stumbled upon this presentation, which actually mentioned this, what you said about cost of capital. And I was like, wow, that's weird. I don't think I've ever seen something
Yeah.
like that. And they were tracking, here's our cost of capital. It's 6.8 and 6.9. And our target is this. I was like, oh, okay. Yeah.
It's really funny because when you talked to Japanese companies 10 or 20 years ago and you talked about return on capital, cost of capital, they didn't know what you were talking about. It was a concept that it didn't register. And now it's in every presentation. And the funny thing was, we met one company that had a market cap of $200 million or something and was trading below its cash value. And the owner would never pay out that money. So there's a reason why it trades below cash. It's a reason because it's a net. So I wouldn't recommend buying such a company. But what's interesting, even they had the slide in there about return on equity and the price being below book value. So even they talked about it because everyone else talked about it, and so they wanted to be part of that group. I think that was interesting. So you still have to see what is the company really doing and what is their philosophy. So you still have to do the work, but at least you can talk about it. At least they will tell you what they think about it. Whereas in the past, you wouldn't have gotten an answer.
I mean, can they come out and say, well, our return on equity is actually, I don't know, 10%, let's say, because we calculated X cash.
They don't do that, but that's what my colleagues, that was Clemens is always looking at, a colleague of us, Poma, because he's looking for companies that have attractive returns on operative capital. So that what
Yes.
kind of capital do they need for their operations?
Yes.
And then what will they do with the surplus capital? And if they don't do anything, then you'll never get these returns on operating capital because it will always be diluted by too much. But the easiest measure to increase your return on equity and to maybe also increase the price above book value is to give more money back. It doesn't have to be buybacks, can be dividends, and that's what most of the companies do. So not nearly all, I don't know, but many of these companies before they actually increase their dividends quite significantly, and they don't have to earn the money. The money is already there on the balance sheet, so it's an easy measure for them to pay a bit more dividends. So that's like the first step everyone does. So if you get better all the day, they say, okay, fine, let's increase the dividend. So that's the one measure. But there are other companies that are much more conscious. They're really thinking about what kind of capital do we need, what do we do with the rest, how much do we want to pay out. And the two companies, because maybe just to explain, because in your podcast, you also want to talk about stocks. So I picked two stocks and disclaimer, this is not a recommendation. I'm just curious in the business models. Some clients of Gutmann might own this stock. And I personally own JVC Chemboard. I don't own Nippon Paint. Just full disclosure. I want to be fully transparent. It's not a recommendation to your own research.
Beyond these, let's say these push by the stock exchange for this better capital allocation, etc. Is there anything else going on in Japan with the economy, with demographics, with other trends or new industries or whatever that you'd like to share?
Sure. I mean, all these macro problems, I would call it, they are probably there, or they're certainly there. So demographics is certainly a challenge in Japan, like everywhere else. Population is shrinking, and in Japan it's even more difficult because it's more of a closed society. And I made a point to ask each of these listed companies how they are doing in attracting people and how they feel about it. And the interesting thing is, that was also something I learned, I think, is that why are these very small companies even listed? And one reason is that the reputation is higher working for a listed company. So it gives you more face if you can say, I'm working for a Tokyo Stock Exchange listed company. So it seems they're still having a better position attracting talent than non-listed companies have. That was my impression.
Did you have, as an investor, we have currency risk. I
Oh
don't know if
yeah,
you have any
definitely.
thoughts on that.
That sucked. I mean, the yen really, the weak yen really hurt returns. So you can hedge the yen, but if you're not hedged, that hasn't helped over the years. And you had this one day in August last year when the yen moved, but now it weakened again. Yeah, I'm surprised. And inbound tourist travel is at I think all-time high in Japan. Everyone is going to Japan because it's so cheap. It's a beautiful country. People are so well behaved. Tokyo is a huge city, but it doesn't feel crowded. It doesn't feel uncomfortable. So they really did a great job there. I'm always surprised that the yen stayed so weak.
Yeah, because let's say if you were even your USD, let's say whatever investor, I'm seeing like from 5 years ago, it's roughly from like 100 to like what 150. So basically, even if you made 50% on your Japanese investments, let's say, then you still haven't made anything
Sure,
in local terms.
that's true.
It's an interesting society. I want to go eat at those 7-Elevens or something in Japan.
Yeah, I mean, they have these department stores or buildings where the whole floor, there's one floor, there are only restaurants, and you can go in any one of them and they will be all good and cheap. So you go there in there, and for $10 you eat, and it's really good. So it's amazing. And why is that? Because they obviously they cannot live on the tourists, so they have to live on the local population that comes there every day, and so they have to deliver something that's good, that people come in. But what I maybe one aspect about Japan, what I found attractive is that Japan always had, or many companies had this discount. Maybe not for the truly big international companies that are more trading on a peer level to other companies in other regions, but for the little bit smaller ones. So what I recognize is that many companies are, first of all, very conservatively financed, so that they certainly have an opportunity to lever up. But even if they don't do it, if you I think there are certain investors who feel more comfortable investing in companies that are more conservative on the balance sheet side, so you don't have bad surprises there. So you'll find them in Japan. And then I always like to joke, if I look at the companies and I see a company trading at less than 10 times EV/EBIT, so enterprise value to operating earnings, I'm surprised. So it's hard to find in the US unless it's some business model that's not growing anymore. There's some problems. But on the other hand, if you look at Japan, you very often find companies trading below 10 times EV/EBIT, and then you look at them and they're just fine. They're doing well, they're growing, and you wonder why they're trading cheaply. And somehow I think there's like this consensus that Japan is that way, but I don't think it is that way. And I think at some point that will change, because why should there be a systematic discount if the company is doing the right things?
Well, yeah, as long as they continue to start thinking more Western with regard to cash and capital allocation, and what about these cross holdings? I mean, is it changing because it's like you have a company with a bunch of cash and it's trading cheaply. You should be able to have someone go activist on it.
Definitely. So these cross holdings, they are concentrated obviously in the big companies from the volume, because in the past it was just the way you did business is that your supplier bought shares from you of the supplier and your client, and so to strengthen the relationship, everyone was buying the shares of the other companies you're doing business with, and then you had all these cross holdings. Now the big companies all started to unwind that, to sell that, and now the next level of company sizes, they followed that example. Because it makes a lot of sense, and now that the other ones do it, everyone feels fine to also do that. So that's happening. There are also statistics on it, how the cross holdings decrease, and that money that then is used to either increase dividends or even buy back stocks. So yes, that money is used in a good way, I think, because it was really unproductive, and that's a good development. But now you talk about activists. So there have always been activists. So activist funds tried to come to Japan and change things, but they were not very successful because the Japanese didn't really care. The board didn't even have to talk about it if they were approached. And there were a lot of poison pills, so you really couldn't do anything about it. They just shrugged their shoulders and say, "Go away." You had to go away. But that also changed. So now there are new governance structures that the board has to respond, and things are happening in Japan. We can also read it in the news, and also the activists got smart about it. They try to work together with management and find a solution. So find a solution where everyone can keep their face which is very important in Asia. And we also, our partners, measure the number of activists coming to Japan, and that really increased over the last years to a large number. So there's much more going on now, and that's also an underlying factor helping Japanese equities. And because you said if the things persist and do not reverse, and it took so long for Japan to implement these changes or to get going, and now that things are changing, and now that the wagon is rolling and everyone is going along those lines, I don't see it reversing, because what is the incentive of reversing it, and who should reverse it? Because now society decided that's the new way to go, and it's like a super tanker. I mean, that won't change direction very, very soon. So I think you still have to do the work like in every other market, like with every other company, but you have now, instead having the wind in your face, you have it in your bag. So that might help you now and there. So that would help you to lift the entire market to a different level.
I'm just curious, have you heard of any recent this case in Japan? I mean, just as sort of kind of like as evidence, things are changing.
Yeah, I have, and I read about it all the time, but I can't tell you. I don't have a story ready that would exemplify that. I'm sorry.
No worries. No
worries.
worries.
The 7 Japan was one of the cases, but yeah, so I'm not the best person to talk about it.
Yep. So, Kenwood, JVC Kenwood. I think I saw you presented this actually as an idea in clusters, if I'm not mistaken.
Yeah, that's right. It's one of the companies that we met when we were in Japan, and also the management. We were able to talk in English, so I could pester them with all my questions, because I was really excited to. I mean, the thing is, when I meet companies, and it was a setting where we had some time, I try to understand where did they come from, and what are they really doing, and I think they feel the curiosity that it's not about some. I really try to understand the business model, so I'm never talk about the stock or stock price or anything. I'll just talk about the business. I'm interested in business, and I think that's also important to see what's going on there. And I found that especially interesting because JVC Kenwood is like a household name for consumer electronics. So in my youth, it was like the JVC Kenwood. What is this? This is not what it was. Headsets and Walkmans and video. I think they even invented the VHS system or something.
Yes, I think I think yes. When I was reading about it yesterday, yes, I think they invented the VHS. And the funny thing is, I didn't even know that JVC stood for Victor Company.
Victor, yeah. And the Victor brand still exists, and you might know the logo with the dog and the transistor.
Yeah. Recently got an audio Kenwood for my car, actually, because my car is like old, and I just changing the audio system turns it into a brand new car. There is so much competition, and it's not just that there's a lot of competition, especially with these consumer products. Everyone has become so much better. A simple example would be, a good example would be, I think, is Xiaomi, right? What my point is that you have all these companies that you've never heard of, or that are coming up with this really high quality. They're no longer, these cheap copies. They stand on their own. So maybe you can provide some insight on that. Is that an area where they're trying to move out of now and just focus more on the professional side?
Definitely. Yeah, you're completely right. I mean, the whole consumer electronics segment is super competitive, and that's what nearly did them in during the great financial crisis in 2008. They were nearly bankrupt because this you described it, but they somehow like the phoenix out of the ashes. They came back with one business that's actually not in Japan. And that's also interesting about JVC Kenwood. I think the one business driving the whole company is actually a US business, because in US it's really the safety and security sector. So did I get it out? Safety and security sector. So if you look at the US, on the state level, there is Motorola is the big player. so forth for all the communication, police, fireworks, security, whatever. And Motorola is the big fish in there, and they've done amazing, and they've a great business model. But below the states, there are the counties, and there are like 3,000 counties in the US, and some of them are too small for Motorola to really compete. They're competing in the bigger ones, and JVC Kenwood came in there through their US subsidiary, and they are selling to police workers, fire workers, universities, whatever have you, the communication systems, because you can't use your mobile devices. You need something separate. So you have your walkie-talkie, so to speak, and they also go from analog to digital. And so you have these RFP processes, and what I've seen now and then, that is that JVC Kenwood was the only bidder for some of these contracts. There used to be a Chinese firm or some Chinese firms that competed, but they're not getting any business in the US anymore. So that's where JVC Kenwood is really growing, and that's where all the operating income, nearly all of that is coming from that area. And so over the coming years, that will be really the driving force. And if that would be a US business, I think they would have long spun off or sold the automotive part. But I think it was hard enough for JVC Kenwood to really right size the ship when they were nearly bankrupt, and because in Japan it's not so easy to getting rid of people. But now I think they're in a good position to move forward. And because devices are produced outside of US, JVC Kenwood was hit by the tariffs, but I think the whole impact is not as big as was feared by the markets, because it's certainly a short-term dent, but I think longer term it's not really stopping the business on that side.
So in general, the company's going to get hit by tariffs.
Yeah, but it's mostly they can pass it on in the pricing.
Okay.
I mean, to give you an idea, there was Crawford County. They wanted to have a county-wide emergency radio system, and the lone bid was coming from JVC Kenwood, and the subsidiary in the US is called EF Johnson, and the bid was for close to $17 million. And I think they also have a consultant, and so the county has a consultant, and the consultant said, okay, the estimate is that this will cost between 15 and 20 million. And so JVC Kenwood was right in the middle of that one. And so if the tariffs increase the price of the devices, so these are the few percentage points, they're easily absorbed by the price. So that would not have made a difference for that bidding process. For example, that's just one example. So I'm not concerned about.
Why did they only get one bid? I mean, that's crazy.
Yeah, and I think it's that because that there were these Chinese companies, and they are not competing anymore because of political situation. You don't want to have your critical communication system provided by a Chinese company, and probably Motorola said that's too small for us. Maybe it doesn't move the needle, so to speak, and so that left, I think, JVC Kenwood, as far as I can understand it. What I also liked is that, because we talked about all these measures that the Japanese companies do, but what I want to see is clear measures. What is your shareholder return policy? And JVC Kenwood said, okay, we'll do a total payout ratio of 30 to 40% through dividend and buybacks. And so I think for 2024, they were above that. They were like 42% or so. And it was a combination of dividend and buyback. So they committed at that, and they are executing on it. And what I also liked is that management also has some stock, that they had also some stock incentive program where senior management was able to invest in the stock. And so there are different incentives that I liked. And they also increased dividends, by the way. So yeah, it's all these different measures. So you're left with the normal business risk, which is always big enough.
But, it's interesting. I think, that area is also, they could also go hospitals as well, construction. I mean, the whole
there is construction, there's industry
Okay.
on industrial sites, there's communication.
So, yeah.
That there are different parts to it, definitely.
there's a whole niche area where they can serve, and it's kind of funny because actually I had a meeting, and I was just looking up this stuff. This is why you see me looking at the screen. Is I had a meeting with a guy a month ago, and this was a family office, and he was actually telling me about like a similar company in the U.S. And I just looked it up. BK Technologies. So you might want to pull that up. So BK Technologies also has these sort of radios for these sort of solutions. So, and he
I've
was
seen
telling
them.
me that where these guys were bidding, this is a small company. It's listed. It's listed. I don't have the ticker in front of me, but these company were bidding somewhere, and it was just them and Motorola. So that is the one takeaway I thought from that meeting was like, wow, this is a cool little niche area. And then you came and told me about Kenwood. I was like, okay, so there's like 3, 4 companies here. That's doable. And these things aren't particularly cheap, it seems. Although Motorola seems to be the premium.
Oh, definitely.
Premium person. Oh, here it is.
We have one Value X friend who said he's working for the fire work, so that I don't know what you call it when you support the fire. So it's in your free time you work for the firefighters. What do you call that in English?
Oh yeah, volunteer firefighter.
Yeah, exactly. And he's in New York, and he said it's all the gear and everything, communication, everything has Motorola on it.
Okay.
So yeah, they're definitely the big one. That's the biggest competitor they always see out there. That's for sure. But it's interesting that also, like, there is over 3,000 counties, and more than 50% are still analog, and they also have to switch to digital. So when they switch to digital, they will go out there and get the bids in. And it's also interesting if you implement that, then you also have some service part to it. So I'd say 10% of the initial revenue is recurring revenue, which is also interesting. And they also have a backlog.
Yeah, I think it's interesting because Kenwood is 186 billion. So that's about 1.2 whatever billion dollars. I mean, I was just looking up this company I just mentioned. So BK Tech is 150 million. There you go. You call up Kenwood and tell them, hey, start buying up your competitors. Okay, so they've so they've said they're doing the security and safety. I'm guessing part of their plan is also to focus more on the professional. Are they getting rid of any of the other stuff, or are they just gonna just do less?
Yeah, that's the
like entertainment. They don't make any money in entertainment.
Yeah.
So
it will be less and less. But I haven't heard a credible plan. But I think they are. When you see over the years, they increased the staff on the safety and security side, and the reduced staff on the other side. So they're going as fast as they can to shift the business there. I think that's still an issue in Japan, that it's not so easy to what do you call it, downsize the company and to take all the necessary measures that the US company would take. So you have to do it in a measured way, keep everyone happy.
The stock has come off a lot from its highs. I think it was like 1750. It's come down. Is that because of the tariffs and revision to guidance?
Yes, that was a big measure, and also that I think also that the revenue before that wasn't exactly where they were, because they had some issues with that they couldn't get delivery of the devices, so there was a backlog there, and it shifted it to the next quarter. Yeah, I mean there were some. I think because the stock, the whole share registry probably changed over recent years because they were nearly bankrupt, and then they resurfaced as a new business, so to speak, and then the stock price went up rapidly because some of the market recognized that they're now making money in different areas, and now I think there was some probably too optimistic assumptions of what growth would be, and it will take longer, so it completely re-rated again. But I think it's just an interesting business over many years to come. And now the price with single-digit EV/EBIT is quite unassuming. But it will be volatile, and who knows where the stock will go in the coming months, up or down, who knows.
What do you think would be fair for this? Or what do you think it's worth?
Yeah. I think why shouldn't it be trading at 15 times EV/EBIT and not 10 times EV/EBIT? But I'm not really betting on any re-rating of the valuation. I think the big driver will be the underlying business, so that the area of safety and security will grow. That's also what the management expectation is, that it will grow strongly over the coming years, and that will provide all the operating income, and that operating income will go up over time. And I think the stock price should also move with the underlying development of the business. And at some point, maybe on top of that, there will be a higher valuation awarded to the stock. But I'm more betting on the business than on a re-rating of the stock valuation.
Okay, so before we go to Nippon Paint, do you have any other comments on Kenwood, or shall we just move on?
No other comments. Maybe would also be good to talk about Gutmann's position on Japan in general, just for a minute, because we are really a bottom-up stock investor. So our equity team in the fund company picks business models where we are owners for a long time and have known them for a long time. And then we talk about Japan, which sounds more regionally, but I think we implemented the same philosophy with an outside team that manages in our fund structure. So also they are selecting single companies, but on the one hand, that have a competitive edge. They are very competitive on an international basis, but they also have like half of the money in small and mid-cap companies where this big valuation discount still persists, and where things are coming in that change that. So as you mentioned, also activist investors, but also management themselves and owners are still owning families are having a different approach now to capital allocation. We have actually 12% in Japan there. And if you look at the weight of Japan in the world on a market cap basis, it's around 6%. So we have double that amount in Japan. So just saying that we also have in general a significant size in Japan. Just also as a full disclosure. But everywhere diversified, so around 60 companies are in there.
So at Bank Gutmann, you're treating your investments as business owners rather than in and out long-term positions. You think about the businesses driving the stocks. You guys do some modeling, you said to me at a different point.
Yeah, my colleagues, so the equity team is part of our fund company, and we are following the business models very closely. So obviously on all these quarterly calls and doing the write-ups and trying, is the business model still on track? And many of those business models we have owned for more than 10 years. But what we do in our core strategy is to rebalance or to equal weight the stocks, which when I came to Bank Gutmann, I wasn't convinced that it's a good strategy, but now I'm convinced that this is a good thing to do, because on the one hand, you don't have to worry about all these concentration discussions like you have in the markets now. We have owned NVIDIA since 2018 and some of these other big tech stocks, but through the rebalancing, for example, in NVIDIA, we have taken more profits than we had all invested in NVIDIA. Sure, in hindsight, it would have been better to just hold on to it and let it balloon. But I also feel more comfortable talking to clients when they put money in, taking money out. They always know that they are entering a solid portfolio where they're not only past performance and it might give back some of that, but you also, we take some active measure there. And what it does to the portfolio, it makes it more defensive also, because you normally lag on the way up because only a few things pull the market up and you obviously never have enough of them. But when things correct and go down, like it was through April this year, we also hold up much better. So we had a big outperformance during that move because we are much more balanced and the portfolio keeps up better that way. And what I also like is that the equity team, if a stock goes down, that the equity team cannot only just watch it. We had one example some time ago in Insulet. It's in the diabetes area. They are offering these devices, very advanced devices that administer the insulin at the right time. And there was a concern that it will not grow as much in the diabetes 2 area because of the new GLP-1 medications, these weight loss drugs, Ozempic, Mounjaro, and the stock price halved. And so in a private portfolio, someone would say, okay, now it's a small position. I'm not looking at it. Let's see what happens. But we don't have that luxury. So every 3 months, the equity team has to make up the mind. Do we want to double the position in that case because it just halved? Or do we want to get rid of it? In that case, we up the position again. But in other cases, we had to sell the stock. And yeah, that's the risk. If the stock price goes down and you rebalance, you add to the stock, but the business deteriorates, and you watched it for too long, that can be quite a drag. So yeah. But we also sell. We also make mistakes, no doubt about it, and we sell business models that are not working anymore.
No, I think that that's interesting. I think it's really interesting. I like the idea of the trimming. Maybe a variation of that would be depending on the valuation. Like, for example, let's say, because if you think about the NVIDIAs or the Teslas or whatever of the world, or let's just go even more basic, like something like Costco, right? And you've got a ridiculous multiple, like what is, I don't know, what is Costco at, like 50 times or 60 times, something like that.
Multiple, yeah.
So, great business, keeps going up. It's not coming back. And it's actually, what's funny is I did a valuation workshop and I pulled from the Bible, right? I pulled from the Bible the DCF they have in here on Costco, right? So if you had bought this book and you looked at the DCF and you're like, okay, oh, wait, it's like, something like 220 or something, right? And you looked at the chart, it never traded there.
Yeah.
So even the greatest minds of valuation, no one's perfect. So if you held Costco, but it was in Bank Gutmann, in the Bank Gutmann strategy, you'd be like trimming. So if it re-rates, then you've taken all this profit. And I guess, so you could say, I kind of like the idea of that trimming for like these sort of positions, like the NVIDIAs or whatever, which is highly priced. But then if something is reasonable, let's say you had Meta, right? And Meta went to 100, and in that would, that would be a great case to be adding. And even though it might then come and hit that whatever 2-3%, it's the valuation might still make sense. You know what Sure. So I think it's interesting from that aspect. I don't know if I could do it, just because on the downside, it sort of hurts to be adding to a losing position. But I'm sure you guys are in a better place than me deciding on my own, because you have an entire team there, and with the access that you guys have, you're probably better informed to, fingers crossed, to make better decisions than your average investor, right? So I think and you can see this in the Insulet. Like, I just pulled it up and I see it went from like 300 dropped to like 125 in 23, and now it's back at near 300. So that sort of thing can pay off if you're on top of all these on top of
and
all
it's also
positions.
I completely get your point, and there's always a fair argument about what's a sensible way to manage a portfolio. And I think if you manage your own money and you can just hold a few stocks, and if one stock runs up and you hold 30% of your portfolio in one stock, yeah, great, a wonderful outcome if stock goes up that much. So that's a big portion of your portfolio. But if you manage money for a lot of people and they're already rich and want to stay rich, and they're here and they want to get there, and in between there's a lot of this, so you want to make sure that they get there and you don't lose them during this. So you have to find a strategy that makes it likely that they will reach their financial targets. And I feel much more comfortable with a very well balanced, well diversified strategy but that is not an ETF index strategy. I mean, you can also have that. If you believe in indexing, you can have that too, or you can do that on your own, whatever. But I feel much more comfortable with that strategy because I know I'm always getting people into a well-balanced portfolio that doesn't have concentration risk, that in an environment where the world gets suddenly more unsecure or people feel frightened, stock prices go down, that will normally hold up better. So I think the whole feature of that portfolio caters very well to a private banking environment and to getting people to the other side of a program or the other side of a big volatility move. So these are also philosophical thoughts in my head. So it's not as easy as just managing my own money, you know?
Yep.
I'm buying a stock and it halves and I say, okay, fine, but it's different.
I agree. Here's the thing, what people don't realize, people get so obsessed or worked up about the whole ETFs, blah, blah, blah. Where is it at least not in my education, where is it say that it's mandatory that everyone has to beat the market? Why is that all of a sudden you have to beat the S&P? There's a rule there? I don't know of any such rules. Here's the thing. It's like what you just described, right? If I don't want to take that amount of risk, right? If I'm already, especially if I'm wealthy, let's say, and I want to maintain that wealth, I don't give a damn what the S&P does. You know, what the average high net worth person wants to maintain being a high net worth person. Doesn't care if he's underperforming or overperforming. So, you know, what if I have a whole freaking basket of consumer staples, let's say, right? You know, lower beta, and it's underperforming the S&P. Is that a sin? Is that like violation? Should I be shot? You know, should I be like, they take the CFA charter from me? I don't think so. I don't think so. I mean, this is what the whole freaking industry is all worked up about, and it's not. I think it's not the right way to think about these things. These things are like exactly like you just said. I mean, what is the goal? What is your goal here? And what are you trying to do? Okay, if you're trying to beat the S&P, then go about that route and see what increases your probability of doing that. If you're trying to maintain your wealth, that's a totally different thing. So each person, if you're trying to get rich quick, then you're probably on Reddit reading Wall Street Bets. So, you know, it really depends on what each person's goal is. Go ask the guy who's playing roulette. Is he trying to beat the S&P? No, he's trying to make what is the payout, 35 times whatever his whatever bet is, right? Whatever it is, 35, 36 times or whatever. So
I think if you're responsible for other people's money, you have to think about all kinds of risks. Certainly, we all need a yardstick, and we compare ourselves to indices. It's important, but I think there's much more to it. I mean, you have to look at your client and what are their needs and what do they want to get out of it. And nearly all of our clients are not 100% in equities, so they can't even stand 100% in equities. So you're right. Is then how important is the discussion about the benchmark, and if you're a little bit above or below benchmark, I think it's much more important that you have something for them they can sleep with, and but still compound and still protect the wealth and protect it in a real sense. So after inflation and after cost, and these are much more important targets for them than beating the index. That's for sure.
Exactly. We both know people who do turnarounds or bankruptcy stories, right? And they're specialists. They do really well. They're very smart, you know, but just because, you know, that niche there does extremely well. I mean, the number one question is what you said. Can I sleep at night with that?
Yeah.
You know?
Exactly.
The money won't help if I'm dead because of a heart attack.
That's true.
So Nippon Paint. So we're going from walkie-talkies to decorating our house, because that's I think our focus here with Nippon Paint is decorative paints. Is that what's gotten you into this?
Yeah, good question. Because I mean, normally I don't talk about stocks, and if I talk about stocks, then I talk about Gutmann stocks, like we did a little bit before. But in Japan, it's different, and I wanted to showcase two companies that are listed in Japan but there's much more to it than only Japan. That's somehow I like the story. And as I said, it's not a recommendation at all. But Nippon Paint I came across through a mutual friend of us, Girish. And Girish is founder and partner of Tenko Partners, and I'm so lucky to receive his letters. And I think he's really, we often call him the investment philosopher. I think he's such a deep thinker about investments, and I really always appreciate his thoughts, and that's why I also like to read his letters. And he only mentioned the name once there, so he didn't talk about it or anything. So many recommendation by Tencor. I just happened to see the fact sheet and I saw the name on it. And so I said, oh, it's interesting. I mean, Girish has a Japanese stock. And so I started to look at it on my own, and I was just curious about the business model. And I thought, oh, that's really interesting and unusual because Nippon Paint has existed for a long time. 1800, I don't know, 80 or something. They were founded, and but then they had a partner for the Asia business in Singapore, Go Cheng Yang, and this business became bigger and bigger until that arm took control of Nippon Paint. And Go Cheng Lang, hopefully I'm pronouncing it right. I think he's one of the richest, if not the richest person now in Singapore. But he's approaching 100 now, so he's in the Buffett age category, born in 1927. But he's not the one running the shop, so it's his son. He's much younger, in his 70s, still a young guy. But he's obviously on the board. He's just.
You mean the chairman?
The chairman, right. And so they're now the biggest paint company in Asia. And why at all mentioned the company? So first of all, because I read it in Kirish's letter, and then I opened up their investor relations side and looked at their reports. And what jumped at me was our only target is maximizing shareholder value. That's what they state. So I said, oh wow, that's refreshing. But it's really also showing that they're in. I mean, Japan is an interesting country. I think there are close to 4,000 stocks listed on the Tokyo Stock Exchange. So it's really a fertile hunting ground with all kinds of different companies. And that's why I just wanted to highlight those two companies, just showing there are a lot of domestic companies that are also active within Japan. There are international companies that we all know. There are Toyotas, Nintendos, but also Keyens and SMC in automation. So there are world-leading companies out there. But there are also companies that have a more unusual story that are listed in Japan. And the one is JVC Kenwood with the business in the US. And the other one is Nippon Paint with being the biggest paint company in Asia with the biggest market in China. Just showing that that Japan has a lot to offer for all kinds of different investors. No matter if you like very undervalued small cap companies where you hope to unlock the treasures on the balance sheet. Sometimes it works, sometimes it doesn't. To some other stories. So I think Japan from that perspective is quite interesting.
I think it's really good if you're having this cultural change or this, this new focus, because I was looking, I think Nippon Paint, I wasn't really impressed by the returns on capital, return on equity. And then I saw the big family ownership, and I was like, a combination of being a majority shareholder, a majority owner who's not really had the best allocation, sort of like for me is a little bit of a red flag. But I think it really is interesting. I'll be honest, I've never heard of it before, but
yeah, me neither. But I looked into the paint area, and it's really interesting business. So now and then I came across some paint companies in Austria and Germany that are not listed, and I saw that they are doing good business because you have brand recognition, and there are some mechanics at work that enable higher returns that you would normally assume. And Nippon Paint, they want to grow organically and through purchases, so they purchase other companies and add to the portfolio. And they work, so they let them run decentralized, but they still want to enable them to use the core knowledge, to use the marketing, to use the Nippon Paint brand as a premium brand. And I think through that combination, that works quite well for them. And they also state that they want to grow earnings per share. So for me, it's not that the best measure. Yeah, at least it's not some number that's not had nothing to do with the share price. So at least it's per share. So they want to grow that. And when you look at it, what they're willing to pay, so there's a lot of thought going in there too. And you might have recognized that they do have two like co-CEOs.
Yep, I saw
and
that.
One is really the operating guy, has a lot of operating knowledge, and the other one is more coming from the capital side. Advised them on the deal with the Singapore owner. So I think they have, I found that solution quite attractive. Yeah, but I just wanted to showcase that as an example. I mean, I was just curious about the business model. I have to follow it more myself. So again, no recommendation.
You are a big fan of Japan. You think things are changing in Japan. There is a potential currency risk here, but there's interesting stories for people to check out, like JVC Kenwood and perhaps Nippon Paint as well. Is that a good summary?
Yes, sir. And there's much more to it. I mean, as I said, only two showcases. We are very diversified in Japan. We have over 60 companies there, a lot of small and mid-cap companies too, because there is also an opportunity there. Yeah.
So wait, you have 60 positions then in Japan for Bank Gutmann.
Yeah. And as I said, our partners at Spoma, they're managing that for us because we need some power also on the ground, looking at the companies and understanding the Japanese mindset and being there and in it. So that worked quite well for us.
Is that also equally weighted?
No, it's not. It's not.
Okay.
But positions are hardly above 2%. Sometimes they might be 3%, a little bit over if something runs up. But it's that's the interesting thing I've also found. If you look at the number of funds that are not highly concentrated, like some of our friends are, but are more diversified when they own like 50 stocks or so, then at the end of the day, what is really the difference if you have the biggest positions at 3-4% and then going down to 1%, or if you have 2% equal weight? So it's not that far away anymore. I think there might be some differences in the mechanics, but no, it's not equal weight. Just got me thinking about that some people are not so far away from equal weight.
So if you have you have basically 11% in Japan, which is
12% in Japan.
Oh, 12%.
Of the equity portfolio is in Japan. Yeah.
So 12%, which is allocated to basically these 60 companies.
Yeah.
What the rest of the portfolio? How many companies are there in the rest of the portfolio?
So the core strategy has 50 companies. That's the biggest position. That's 68% of the equity portfolio. But then we also have 15% in a dividend strategy also. So at the end of the day, you have a lot of companies in the portfolio if you look at the different strategies. But more than 2/3 are in our core strategy that has around 50 stocks. So that's definitely
just this is a little bit off topic since we've been talking about Japan, but just regarding the portfolio management in general do you guys are also involved in emerging markets? Do you have a view like China? Or is it, we don't touch China because, there could be problems with the US, or we don't touch Eastern Europe, or we don't touch Africa, or,
So if I can, we can slice and dice the portfolio in different ways. But if I look at it from a regional composition, then it's about 60% US, 30% Europe, and then the Japan part. So it's then probably not 60, 30, 10, but 12 is Japan. So you have to do some rounding there.
Yeah.
So roughly. So we are not in emerging markets. We used to be in Asia some years ago, but after Russia, Ukraine, we reevaluated and we got out of China. But we are not. I'm not saying we will never again invest in China. So we're still looking at companies, and maybe one day we'll add a Chinese company just to be involved, to be more involved again. But so far we have no China, no emerging markets exposure on the equity side, or also not on the bond side. Yeah.
Oh yeah. Okay. Okay. So unless we have anything else, we'll wrap it up. And
Yes, sir.
well, Robert, thank you. Thank you for coming on the podcast. This was fun. And I look forward to seeing you in Cyprus in
Yeah, I'm
September.
looking forward too. That's great. That's great. And I've seen your again, as every year, booked out, fully filled. Everyone wants to join and be part of it. And I'm looking forward to see you there and then meet all these great people. It will be a blast, that's for sure.
It will be. I'm next week going to be with the family, so I'm going to have to go through a nightmare and wait myself until September. So take care, Robert.
I wish you a great summer and great talking to you, Sophocles.
Yeah.
Thanks.
The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.